Good morning. We are going to explain the case of Lady and Confection. Well, um, Lady and Confection was founded in 2001 as a cake wholesale business. This company has a differentiation of quality and taste. Also, it has stores in different cities, three in New York, one in LA, with 120 total workers. The company has had huge sales growth with 81% in 2013. Now, Lady N Confession has to make a decision. If the company invests in the World Trade Center location in New York, consider rental and construction costs, or if the company accepts the Chinese investor offer, considering of 10 millions of dollars and a line of credit by giving all franchises right in China.
Talking about Lady M confection strategy, they have a differentiation because they have a product of high quality, that is the mild crepe, inspired in Japanese and French bakeries, a luxury boutique that won a design award, and not low cost strategy because the products are really luxury. Talking about the company's growth, they opened a new boutique in New York and Los Angeles. They have more employers now. Their sales growth in a 81% during 2013, and the profit margin is from 11.4. That is very rare in their sector because normally they have a profit margin of one number. Also, they focus on niches because they have their own niche market. That is people who focus on less sweet, aesthetic, pleasant baked goods.
To calculate the break-even, we consider the following expenses that are rent, annually utility costs, depreciation costs, annual labor costs, and amortizations. Also, the cost of goods sold. According to the case, the rent and the profit cost will increase by 3% annually, and the annual labor cost will increase in 5% in the same period. Also, the cost of goods sold will be 50% of the item sold, and it will be maintained through the 5 years. Well, in addition, we are assuming that there are no financial costs and that all the cost mentioned are predominantly fixed costs. Well, based on this, we use the following formula, and the contribution margin per unit means that total sales revenue minus the cost to make production. Well, as we can see in the graph, for the first year, a total of $2,287,988 will be needed to sell to cover all the fixed and variable costs. And it would be in total 28,560 cakes at $8 each cake.
About the question number 4, we made two predictions, one with a realistic scenario and the other with an optimistic scenario. Performing the free cash flow calculation, considering an annual sales growth of 5%, the net present value is negative, which means that the project produces losses. Also, the internal rate of return, equivalent to -2%, is lower than the interest rate, for which we consider a margin between 0 to 5%, since the text mentioned that it is a low fee, which means that the investment should not be made. On the other hand, with an annual growth of 20% in sales, the net present value is positive, which means that the project will produce profits from the second year, and the internal rate of return is equivalent to 27%, and is higher than the interest rate considered, which means that the investment should be made. Therefore, consider that the company also have a sales growth of 89% in 2013, and is that not have maintained low prices by focusing on a differentiation strategy. is likely to think that the sales will be greater than 20%. In addition, it would allow them to generate profits from the second year. In addition to being located in this place, will be help the brand to become more known and also strengthen its exclusive brand image. About the about the about the value, after performing the discounted cash flow analysis, we obtained that the value of the company is equivalent to more than $261 million. And likewise, we must be have in mind that it is important to use a multiple of EBITDA as a secondary valuation method in order to can corroborate that the direct valuation method that we use has been carried out correctly.
Furthermore, as mentioned, to calculate the value of the shares to sell to the Chinese, we use the company WACC valuation, and we divide this amount between the capital stock that we have in the balance sheet, and we assume that each share costs $1 per share, and with that, with value of each share will be like 138.58 dollars, and in total the Chinese investor will have a participation of 3.83%.
Talking about the assumptions made by Romanizing and Toms, we think that they are not too well made because there is an incongruency between the break-even point and the projections. Also, the utility cost is considered as an almost fixed amount when in truth it should be related with the unit produced. They are not considering the inflation because the value of the money in the time is very important. Also, the sales, general, and administrative expenditures should not remain constant for the next 5 years, talking about the company in general, because if they are going to expect to open the World Trade Center, they are going to have more expenses. And the same applies to the research and development. Over the years, new competitors will appear, and it is important to constantly innovate in order to don't lose their consumers. And also, there is not a correct market study that they have to make.
About if we would recommend to accept the offer of the Chinese investors, the answer is yes, because it is an investment of $10 million that, considering the value of the whole company, these investors would only own 3.8%. And plus, they will give a line of credit that can be used to start the construction and other expenses related to the new store in New York City near the World Trade buildings. However, if management and the shareholders of Lady M prioritizes keeping the expansion strategy to themselves, such as the franchising and licensing rights to enter other markets such as China, we wouldn't recommend the offer.
And well, we will invest in the company because earnings per share, that is the money earned by the company per share, has been increasing significantly in the last 4 years until 2019, which is an indication of profitability, since the higher this ratio, the more profitable the company is considered. About the return on capital, which is indicate the ability of the company to generate income based on the capital that has been used, has increased steadily over the last 8 years. And debt to equity ratio has also increased over the years evaluated, which is associated with a greater risk on the part of the company, which has been financed its growth with debt. However, it should also be considered that the more risk there is, the investors can obtain a greater return.
About the conclusions and recommendations, first, it is important to analyze the projection of sales, the return, the leverage, and the value of the company before making any investment. Therefore, investors should work in the financial analysis internally and with specialized agencies that project this information to make a wise and profitable decision. Second, it is also important to review ratios and some concepts like earnings per share to have notion of its financial situation. So we recommend to base the decision at the general financial situation with well-made projections and assumptions. Lastly, it is relevant to estimate as precisely as possible the fixed and variable expenses to calculate the break-even point and ensure the generation of sales that exceed that amount. And to do that, we recommend to use historical data on variable expenses to estimate future fixed expenses. Thank you.